This is one of the OGs of the tokenizing world.
Makes me feel old.
Well, I've been sort of following these ups and downs, this revolution that happens and then goes backwards. So it's always two steps forward, one step back. But Carlos Domingo, the founder and CEO of Securitize, for those of you who follow this space, probably needs no introduction. But first of all, when was Securitize founded? What year was it?
Actually, next month we're going to be 7 years old. No, this month we're in November already. Completely lost track.
Same age as Propy, I think.
7 years old, yeah.
But
we're like a 7-year-old overnight success.
Exactly. Well, time gets shrunk in crypto time, right? Crypto time moves ridiculously fast. But nonetheless, the journey, right? Like some ups and downs, some successes. What do we just talk it through? Like, what was it like trying to bring these idea of, there was a security token concept and all these ideas at the beginning then in that period as opposed to where we are now? What's changed?
Well, so in 2016, which is when I got into the space, you might remember that was when Ethereum was like starting to take off, and 2017 was like the first bull market that I remember. There was one, maybe 2013 or something like that, where I was not in the industry. So 2017 was the first big bull market. We're probably now studying the one since then, because there was another one during the COVID and the pandemic time. And then alongside like a ton of ICOs, what also came was kind of like the first time the SEC issue a notice to people saying ICOs aren't registered sorts of securities. They were referring to one particular ICO, which was the DAO. You might remember that's what triggered the first fork and first and last fork of Ethereum. And then a lot of people had this thesis that, ICOs are utility tokens, some of them are legal, some of them are legal, but then you can also tokenize all the things. And for the most part, anything else that you think about tokenizing is either you tokenize a commodity or a currency, or you're tokenizing something that has to be securitized. That's why we actually chose that name, or is actually a security. And there was this concept, as you said, of security tokens, which, by the way, it's the same people do now. It's just like it has changed the terminology. So there was a lot of excitement in 2017 about security tokens as a legal alternative to ICOs. It was not about like, let's tokenize a fund or let's tokenize. It was about raising money for crypto projects in a legal way. So we actually did a project before Securitize was founded of tokenizing a venture capital fund to invest in crypto, which was very novel. There was a few companies that did it at that time: Blockchain Capital, Science in LA, Protos in Europe, and us. And then the project was successful, and we started like getting demand of like, how you've done it, what's your technology provider, your platform, etc. So we had the bare bones platform that we have built for tokenizing a fund, and we spun it out thinking, we're going to print money with this because everybody in crypto will follow the regulations. And guess what? Nobody in crypto follow regulations. So ICOs continue happening. We got some traction in 2018, but kind of die out. And then after ICOs, the crypto industry has basically figured out any different ways of issuing tokens without following regulations, whether it was like governance tokens or NFTs or, exchange offerings, like airdrops, like they're super creative.
Geofencing, so that
we're not selling to the US, it's not illegal. It's like, really? I haven't heard that there's no regulators outside the US. The rest of the world, so you can just do whatever you want. So, but anyway, that was the journey, right? So in 2018, we thought, like, what do we do? Because we had just raised our CSA. I actually launched it at Consensus in what you guys used to do it in New York, which was a much better location, in my opinion. That's where you were there. And then we thought, like, well, so if the crypto people don't care about tokenization, the TradFi people might care about it, right? Because this, in paper, it solves a lot of problems of how securities are being managed in capital markets. It's a better ledger, it's faster to move things, it's faster to settle trades, it's faster to enforce compliance, etc., etc., etc. So we then decided to pivot to the TradFi people, and then the number one problem is like, how is this legal? Like, how can you actually issue a token that represents a security? Who tells me, who is the entity that takes, the compliance risk or the liability, blah, blah, blah. So we embarked in this very long journey of basically becoming a regulated entity. Went to the SEC for the first time in January 2019, which is a very different SEC than now.
It's a very different SEC too.
Well, it's very different in the sense that in 2019, they were like, what? Blockchain tokens, crypto? Like, they had no idea. And now they're, we might not like or like what they do, but they're pretty savvy. Like, there's still gaps, of course, because the industry moves very fast, as you said, but they're pretty sophisticated people compared to in terms of like the technology, the regulatory framework, etc. that applies to this industry. So anyway, we successfully got a registered transfer agent, then we filed for a broker dealer. We got a broker dealer, an ATS, and then by 2021-22, after the second bull market that happened right after the pandemic, we started getting traction with the traditional asset managers. So KKR on board, then Hamilton Lane, then in between. That's when the major crypto crash happened with all the credit, FTX, Celsius, BlockFi, Voyager, 3 Arrow Capital, something that half of the industry vaporized overnight. And then after that, something changed, which was the crypto people start kind of rename the security token industry into what people now refer to as the real world asset industry, which is a terrible name. But it's what it is. But it has one thing that's good, which it says these things are real as opposed to imaginary internet money, which is magic internet money, which is what they were doing before. So if we want crypto to be a thing, we have to do real stuff with real assets and put them on chain and kind of leverage those assets to do more things on chain than what they do off chain, and that's the real world assets. And the narrative has helped us to kind of re-pivot back into crypto to focus on tokenization for the crypto industry. Also, crypto, when I started in 2016, was I can't remember, but Bitcoin was $250, so it's $15 billion market cap. The entire industry now is $2.5 trillion. So signing up crypto is a really big industry that if you can carve out a portion of it to do real assets, then it's a big business, right? So.
Has the technological advances helped as well? Because, we've now got layer 2s, the polygons of this world. There are a variety of other ways in which we've dealt with the scaling challenges that would have been, the tokenize all the things was a great idea, but you just wouldn't have had the capacity back then. Does that help?
That's true. So I think that technology has helped, and it has also become more convoluted. In one side, it has helped because now you have the Ethereum. Where 5 years ago they embarked this journey, what they call the roadmap, where basically they're trying to have Ethereum be the settlement layer, where there's L2s that sequencing transactions and roll into Ethereum for security purposes. So Ethereum has stopped trying to scale and has pushed the scalability into the L2s, and now you have Optimism, Arbitrum, ZK Sync, a bunch of Ethereum native rollups that are very scalable, they're very cheap with the transaction fees. You can write, you can evolve functionality much faster, etc. And then you have the alternative L1s, as I call them, which are EVM compatible, like Avalanche and Polygon, or the new non-EVM ones, or new, not that new, but like Solana, Aptos, Sui. So that has helped, but it also has created a very fragmented landscape and very confusing for people to use. I think the other area has improved a lot is wallet management. It's not, you don't need, I don't know if you probably remember, you had to have a piece of paper and write this 24 seed phrase somewhere, because if you do that phrase, you will not be able to access your wallet and have to type it every time you change device, and all that thing has been structured out, and you have things like Coinbase Wallet that have a really good experience, etc. So on one side, UX has tried to cover for the additional complexity we've built that solves problems but creates others.
Yeah. And I suppose one of the big parts of this you've alluded to a little bit is sort of the arrival and the enthusiasm of institutions. And I like this idea that the narrative changed and the RWA was it's a useful term, as crazy as it is, because what is a real world asset? Is the dollar a real world asset? And it is a silly term, but who cares, right? If something's useful in a narrative, it helps. And it seems to me that maybe whether it's the term or just the moment, there was now an acknowledgement from the BlackRocks of this world, for example, and you have a relationship with the BlackRock, so you can maybe speak to it, that, oh, wow, I've got all this liquidity that I could untap by taking whatever it is, the private equity fund that we have, or the T-bills, or and create this tokenized version of that. Just talk a little bit about that as we stand now, and how real is that? Are the institutions coming? We do want to talk a little bit about, of course, post-election now. All that is just maybe don't get the election yet. Let's start with where we've been for the last couple of years. ETFs and RWA being part of the Wall Street conversation.
So I think this time, and I've been in the industry, as Michael said, for 7 years, we wasted a lot of time on pilots that were not real. Were like the random guy in the innovation department that has justified his existence is going to do something with crypto and blockchain, which the rest of the company doesn't care about. That's not the situation with BlackRock has created an entire unit for digital assets, and they're very committed towards, and this is their public statements about, obviously the ETFs, stable coins, they're a huge investment circle, and then tokenization with us, that they're investor and partner for the project. That's kind of like the three pillars of what they do. And I think that the reason they go into this is twofold. One is, first, crypto now is meaningful from a size perspective. I mean, these guys manage $10 trillion. So if crypto is 15 billion, even if they take 100% of it, it just doesn't show up in the list of assets that they manage. So now crypto is big, and if they can take a meaningful position there, then that makes sense for them as a company. And the second, and the regulatory clarity has been improving, and which is going to get better, hopefully, but it has certainly improved. So the ETFs were possible because of the grayscale lawsuit. In our case, we are a company that, as of today, had all the licenses approved by the SEC. Many projects before that, we've never been, we've been examined many times, but never actually, like what a Wells notice or anything like that, or a lawsuit with or an enforcement action with the SEC, right? So definitely, I think it's a confluence of these two concepts. Like the industry now matters from a size perspective, and then the regulatory, clarity is starting to come.
And it is a different realm than, say, the regulatory clarity, I would say, around, utility tokens and the SEC and all of those concerns that do or may not now exist into the future around sort of native tokens. But clearly, there was probably barriers to the advance of this industry because of some of the uncertainty, nonetheless, around security tokens and the like as well, right? Do you feel now with what does it look like now going forward? New administration, specifically for the opportunities for RWA, and what are some of the hurdles that might be solved with a more friendly administration?
So first, I want to say that we have traditional licenses, right? We have a transfer agent license, we have a broker-dealer license. If you look at the regulations for those regulated entities, there is not a single place that talks about what technology you need to use to conduct your business. That doesn't exist. It's not that say, transfer agents need to use Oracle databases or AWS. Like, that doesn't exist. When crypto came, what happened is because of all the perceived fraud, or perceived and not perceived, all the fraud that happened in the industry, and the SEC and some of the regulators like the OCC, etc., they took this position that anything that was touching crypto and blockchain has to be treated more carefully because it's a potential source of problems. And then that impacted companies like us, which were supposed to be the good guys that went against the register, like he says, because we're using this underlying technology that is novel, that has been used for fraudulent behaviors. So that actually made us go very, very slow, because every time we want to improve our licenses, be able to do something new, we have to go back to FINRA, depending on which license, and then do a filing, and it takes a very, very long time. That shouldn't take that long time if you were not using blockchain as the underlying ledger. So what's going to happen with this administration is, first, as you know, the SEC is run by 5 commissioners, out of which one is the chairman, which is appointed by the president. So obviously we're going to get a new chairman of the SEC, which is going to be Republican. The Republicans, if you follow what has happened in the last 4 years, not just only Trump now very publicly supporting crypto, but the last 4 years they've been much more supportive to the industry. I was a witness testimony for the Republicans in the House of Financial Services Committee in Congress in June, and my testimony was very pro using public blockchains, and the Republicans supported that. The witness that the Democrats brought was super antagonistic, and I got attacked by one of the congressmen there while I was testifying because of using a public blockchain, which makes no sense, right? He was telling me, public blockchains are only used for fraud. How can you conduct a regular business on public blockchain? Well, this is like saying that you can't use internet to send money because it's also used by pedophiles or whatever to send other type of illegal activities. That makes no sense. It's just like a nonsense comment. So I think those things are going to go away. I don't think that it's going to change overnight, right? Like, the SEC is a really big organization that has thousands of people that will not change. The commissioners will change, the agenda will change, and the directors will change, of the 5 of the 2 or 4 large departments there, but everybody below will still be there. I think there's going to be change, and then the Senate went to the Republicans. That's pretty good because that was the problem to pass things like FIT 21 or the stablecoin bill. So those things will also move fast, hopefully within the 6 months to a year. And then it's going to be interesting to see what level of the priority of all the things that want to change this comes, right? Like whether it's going to happen the first year or the second year, but it's definitely going to change. What's going to change, I think, is like the attitude of people of being less concerned about the SEC.
And just quickly, what about the potential partners in this? Because I know that the banking industry, we've mentioned BlackRock, we've mentioned these big institutions that are very excited about this, but they themselves they're always wary of what compliance challenges they might face and the ambiguity around some of these laws. And so do you feel as if their participation in RWA projects will accelerate if they feel that there's less risk for them?
I think so, because if they, and obviously I can't speak on behalf of BlackRock, because I don't work for them, but I think if this general concern that it was about, I'm going to get an extra scrutiny for no reason for a company like, let's say, JP Morgan or BlackRock, not to single this out in BlackRock, that they have, trillions of dollars in assets that they manage. They like blockchain, they like crypto, but look, that doesn't move the needle now. It moves the needle maybe 10 years from now. So they're not going to do something that they perceive will jeopardize the rest of their business, right? So I think that now probably they will look at differently, saying, well, we're going to do something. If for any reason we end up doing something that the SEC doesn't like, I'm going to get a call and I'm going to have a friendly conversation with them rather than get a Wells notice and being sued, which was the kind of what happened 6 months ago.
The threat is that has gone, which makes it easier. But okay, just quickly, let's talk a little bit about use cases. I think that clearly here we are at the Propy Summit, and there's a lot of this is the real estate conversation. What do you see as the most exciting applications? First of all, what do you see? Do you see a lot of opportunities for tokenized real estate, for fractionalized real estate, for all those ideas that we've been talking about for the last 7 or 8 years?
Do you want me to say really what I think?
I think this is an open forum, right, Eric? Is it okay?
Look, let me try to answer this politely. I think that, tokenizing this because I register the ownership of this fund in a better ledger doesn't solve any problem. It's just like a bit of an intellectual exercise that people in crypto or in other industries do. That's number one. So when you tokenize something, if it's only to have a better ledger, then it's not going to solve any problem, and it's not going to make the asset more attractive. So if your asset is a crappy asset, just by wrapping it in a token, it's still a crappy asset that is tokenized. That's the only difference. So that's the number one thing. The second thing is that there's this misperception that tokenization makes assets liquid. And that's not understanding what tokenization does. Tokenization doesn't make anything liquid. Tokenization, what it does is it facilitates the settlement and the trading of the asset. But liquidity comes from the fact that you can actually bring buyers and sellers to the asset, which of course they will have a much easier way to do price discovery and settle the trade in a much more efficient, faster, transparent way. But it doesn't actually create the asset liquid. So I think that the industry has suffered from these two misperceptions and then the third one is that just because you tokenize an asset, the crypto people are not going to buy it. Like there was also this kind of like reverse adverse selection problem of, oh, I have a crap here and then I'm going to tokenize it, and the crypto people, because they're flush with money that they got from the internet, then they're going to buy, right? So you have to start with that. It's like, and this is for anybody looking at tokenized real estate, is why are you tokenizing the real estate? What is it that they are going to do with tokenization that you cannot do with simpler technologies that don't add friction? Because tokenization adds friction, by the way. That's what people don't understand. You still have to have wallets, you have to have the stable coins if you want to kind of like solve the settlement problem on chain with atomic swaps and stuff like that. So why are you tokenizing, and what is that? Who's going to be your buyer? Is it crypto people or TradFi people? Because if it's crypto people, then they need to see the value, right? And they need to be able to use it in their ecosystems, integrated with the DeFi protocols, and etc.
I think it's worth noting as well that Propy is not all about the fractionalizing. They really are solving the settlement challenge, right? Exactly. People that fractionalize is a very different structure.
Forget real estate generically. So.
Yeah. But the idea that you solve for that settlement, I think, is fascinating, because the time to close is money that's locked up, right? And so the liquidity in some sense comes from that. The fact
look,
that
I was with Don Wilson, the founder of the RW, yesterday, and he, I don't know, like the old people in the industry will remember, he started a company, or he was backing a company called Harbor, which was one of my competitors back in 2018, and because DRW owns a lot of real estate, they actually did a project of tokenizing student dormitory in North Carolina. And the whole idea was, oh, we tokenize it, we're going to make it liquid. Well, not necessarily. First, who's going to buy a student dormitory in North Carolina? Unless you're like an expert in real estate, there's no way you can actually assess the value of that. Is it good, bad, is the price right, etc. It's a very, very, very esoteric asset that most people are not going to understand what it is. Second, yes, you provide a better fractional ownership, but so can you do that with, digital technology without issuing tokens. And third, it's going to be very difficult that this asset is liquid anyway, right? Because you're not going to have a lot of buyers, and therefore there's not going to be a lot of supply, and then therefore there's not going to be a lot of demand. So even if you can just settle those trades very quickly, you will never find, you will never build an order book to be able to make it really liquid, right?
Yeah. Well, let's leave it at that. Thank you. 7 years of studying, being at the coalface, understanding the ins and outs, the ups and downs, and now looking forward to a bright future for RWA, the word that we unfortunately have to embrace. Round of applause for Carlos Domingo.
Thank you. Thanks.